Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about polymedicure, a company that is uniquely placed in one of the niche segments, and let's understand whether you should buy this company or not. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Now about the company, polymedicure was established in 1995 and they manufacture state-of-the-art medical devices. And these devices are used in many kind of illnesses and in many kind of procedures such as in oncology, in infusion therapy, urology, gastroenterology and so many others. It is a market leader in this space, and apart from OptoCircuits, which used to supply many medical devices earlier, this is one of the largest producers and exporters of medical devices and equipments, and that's why I like this company, Polymedicure, because it is only having a market cap of 2,900 crore. It is not a large cap, and so at 3,000 crore market cap, this is a company that is coming in the niche segment. If we look at the financials of the company, then the profits or sales have gone up by around 17%, but the profit has expanded by around 52% due to better operating margins and operational efficiencies. There is debt, but there's very less debt on the books, and the return on capital employed is 22%, whereas the operating profit margin is also really good and strong at 23%. If you look at the performance of the stock, then the stock has doubled in last 1 year, and this is one part or one point or bone of contention with respect to buying the stock, because the stock has already run up a lot and has doubled in just about 1 year. The numbers have remained strong over the last 4-5 quarters, and the return ratios, as I just mentioned, above 20%. ROE about 28%, ROCE, and operating profit margin to be above 20% as well. So the return ratios in itself are very strong in respect, and it is trading currently at 26-27 times earning, but I believe that it has the potential to trade at above 35 to 40 times EPS, purely because of the segment that it is into. And if you look at probably not equipments, medical equipment space, but if you look at the diagnostic space, that space trades at around 50 to 60 times earnings. So this can easily trade at 35-40 times earnings if you consider a level of discount to the diagnostic companies. There is a high domestic institutional as well as FII holding. There is high promoter holding, and only 12% of the float of the stocks are with the retail investors or are with people who probably would trade the stock, and so only 12% free float is available for you to buy. So why I believe it is a buy on decline? It is in a unique space catering to major aspects of cures. As I mentioned, they are into oncology, gastroenterology, and urology, as well as nephrology. And if you look at surgeries of eye, etc., bones, and so on and so forth, they require products from Polymedicure, and it is trying to expand its base by getting in more clients, more hospitals across India, and that would only augur well for the coming years. It can be a good ancillary play for hospital and pharma sector, because in pharmaceutical you understand that there are many issues with US FDA, and there could be clamped down from anywhere in US to any company. And if you look at the hospital segment, the hospital industry in itself, the listed companies like Apollo Hospital, Max, etc., are not producing results as expected by the investors, and the growth is not at all similar to what Polymedicure is providing. So, a company like Polymedicure, which supplies the products to many hospitals and are into a space where the need for such equipments are always there, no matter how bad the hospitals would work, the equipment need will always be there, and that's why I would suggest buying this company compared to buying any hospital firm or pharmaceutical drugs company, which supply directly to Indian hospitals. There's extremely low debt and small base will always help. So the base of the amount of sales that the company do, as well as the amount of profit of 20 odd crores per quarter, that could really expand very quickly once the company establishes its base across India. Small caps will always be in fashion from now on in for the next 2 3 years. So this is another tailwind that would take polymedicure higher, because the stock is having a market cap of only 3000 crores. So you have to understand that, and the company is making profits after a barren run. So polymedicure as a company did not do well in terms of profitability between 2013 to 16, or later part of 2017 even, but over the last 2.5 years it has been producing decent results, and we have now seen the rewards of expansion and putting in investments or money into different, you could say, products, into different equipments for medical cure. And now we are getting profitability northwards of 50%, which is exceptional. In terms of technicals for the stock, it is extremely overly bought. So 240, 250 would have been a reasonable level to buy, but now the stock has run up to around 350 levels or so. It's better to just accumulate on major declines rather than buying at these levels. So we may see a major correction, and the major support lies around the 260, 275 bandwidth. So any dip towards 275, 280 levels would be a very good buying opportunity, and then a further dip 250 would be an even greater opportunity to buy into the stock. So what one can do is wait for such declines of around 15 to 20% to get in, and probably do an SIP over the next 6 months. And whenever the stock consolidates, it can surely be a multi-bagger if you have the patience, because the numbers that they are coming up with, the amount of equipment that they make, or the type of equipment or medical equipment that they are making, it looks certain that the company could be trading at 12 to 15,000 crore market cap over the next 4 years, 5 years time. So we could see a spurt in the stock price as well as profitability in the coming quarters. The only thing is currently it is expensive because it has run up something like 40 50% in no time. So wait for some correction and consolidation, and only then get into the stock. So what needs to be done? Probably you buy on major declines and keep track of numbers. So any decline of 15% or more, just get into the stock, and get into the stock as an SIP. Do a 2 3 month SIP. So every 3 months you put in the money, or you put in 25% of the total amount that you want to put into the stock, and you will see the magic, because you'll have an average price that will be pretty decent, and you'll be in profit if the numbers continue to be good. And if you hold for the next 6 to 7 years, this could end up being quite a good mid cap stock, rather than being a small cap stock that it currently is, and only have less than 5% of exposure into such small cap companies for sure. So this was my video on polymedicure. Please like and subscribe my channel, hit the bell icon so that you can get my video straight away when I post it. And kindly support me on Patreon. Those that have supported me on Patreon, thanks a lot for that. I'm really grateful to all of you, and I'll definitely bring up more videos of exclusivity on Patreon for sure. So thanks a lot for watching.